Welcome to the deep dive. Today, we're looking at, well, a pretty bizarre contradiction in the world of entrepreneurship, drawn directly from our source materials.
Yeah, it really is a fascinating split.
Right. So, on one side of the spectrum, we have a 16-year-old aspiring founder who has been completely paralyzed for 2 years. 2 whole years without making a single move.
It's entirely frozen,
Exactly. And why? Because they are absolutely terrified of artificial intelligence wiping out their business before it even starts.
which is, a very real fear for a lot of people right now.
Oh, for sure. But then, on the exact opposite end of the spectrum, the materials present us with a 25-year-old founder who has already generated over $25 million in revenue.
I mean, an absolute massive financial win.
Generational wealth. Yet, this founder feels completely stuck. They feel trapped and have just totally lost their motivation.
It's like a study in extremes, really.
Mhm.
And I think it completely shatters the usual assumption that building a business is just a math problem waiting to be solved.
Right, like if you just get the funding or learn to code, it's all smooth sailing.
Exactly. We usually think if you just acquire the technical skills, the roadblocks disappear.
Yeah.
But looking at these two founders, we see this landscape of human behavior and structural business ceilings that are just far more complex.
Which is exactly why today's mission is so fascinating. We've got our hands on some incredibly candid advice from entrepreneur and investor Alex Hormozy, who directly addresses both of these founders.
And his advice is incredibly pragmatic.
It really is. We are going to extract the core business strategy, the growth tactics, and the actual repeatable scaling blueprints he lays out for them.
Because that's what you need, right? A blueprint.
Exactly. We are breaking down the mechanics of how founders actually scale, starting from the raw psychological requirement of building what we'll call a proof stack, all the way to the hard numbers and the deal mechanics of choosing the right high-leverage business vehicle.
The underlying theme driving all of this is leverage. It's really a masterclass in how you leverage your mindset in the very beginning when you have nothing, and how you must radically shift that leverage when the financial stakes get astronomically high.
So let's just jump straight into the mind of that 16-year-old. Picture this scenario for yourself. You have been planning to start a marketing agency for 24 months.
2 years of just planning.
Yeah, you have the idea, you know what you want to do, but you haven't pulled the trigger. You haven't pitched a single client.
Because of the AI fear.
Right, because you look at the horizon, you see the rapid exponential advancement of AI, and you are convinced that an algorithm is going to render your agency obsolete by the time you even figure out how to run it.
Hormozy's reaction to this is, well, it's unfiltered and entirely strategic. He doesn't indulge the technological fear at all.
He doesn't try to predict the future of AI or anything.
Not even a little bit. His advice is simply start 100%.
Just start.
Yeah. And the reason is that the core strategic mistake this young founder is making, it isn't a technological miscalculation. It's a behavioral one.
Oh, interesting. How so?
Well, they're allowing a completely unknown, unwritten future to prevent them from taking action on what is known and controllable today. Hormozy points out this fundamental flaw in human psychology. We drastically underestimate our own ability to figure things out when our backs are against the wall.
You know that concept, like lacking faith in our ability to figure things out? It made me think about how physical training works.
Oh, like in the gym.
Yeah, exactly. If you have never played a sport in your life, the idea of suddenly joining a competitive soccer league is terrifying.
Oh, absolutely.
Right? You don't know the intricate rules, your footwork is terrible, you lack the coordination. But if you just go to the gym and start doing bicep curls, squats, running on a treadmill.
You're building that baseline.
Exactly. You are building baseline physical strength. You're building muscle in isolated, specific areas. So eventually you walk onto that soccer pitch, and sure, you still might not know the exact offside rule, but you feel physically capable.
You trust the machine, basically. Your body.
Right. You trust your physical baseline.
Yeah.
You have faith that your body can handle the movement and the stress.
Neurologically, what you were doing in that gym is building what Hormozy calls domain-specific confidence. And that maps perfectly onto the framework for starting a business.
Domain-specific confidence. Okay, break that down for us.
Well, the source material uses the example of learning to sing.
Okay.
If you decide to practice singing, you put in the grueling repetitions, you train your vocal cords, and eventually, you lose your anxiety about singing in front of people.
You've conquered that specific domain.
Exactly. But then, say you are asked to do some public speaking, Initially, the anxiety spikes again because it is a completely new domain.
Right, because standing behind a podium giving a keynote presentation, I mean, that requires totally different timing and structure than singing a song.
It does. But if you have sung on stage enough times, and perhaps you started engaging in some banter with the audience between your songs, your brain begins to bridge the gap.
Oh, I see.
Yeah, you reach this psychological tipping point where you look at the public speaking gig and think, I have done something structurally very similar to this.
Right. I faced the anxiety of singing, I prepared, I put in the reps, and I succeeded.
Exactly. You extrapolate the effort to success ratio, and then you deliver the speech, and you perform well.
So the confidence leaps from the first domain to the second.
Right. What is actually happening psychologically is that the confidence generalizes. You start to internalize an entirely new belief system about your own competence.
Which is huge.
It is. You realize that whenever you encounter novel, intimidating situations, if you apply the same rigorous preparation you did for singing and speaking, you tend to survive and succeed.
As long as you dedicate time and effort to something meaningful, your brain recognizes a pattern of overcoming obstacles.
Yeah.
And here is where it gets incredibly practical for anyone listening who is, hesitating on launching a project right now. You might not have done the specific thing you're terrified of, like trying to outmaneuver AI as a brand new agency owner.
Right.
But you can extrapolate from your own past history of doing hard things. You build confidence by standing on top of your own track record.
And that is the crucial, repeatable tactic here.
Yeah.
You cannot outthink self-doubt. You cannot sit alone in a room and rationalize your way out of fear. You have to outwork it.
You just have to put the reps in.
Exactly. Hormozy introduces a brilliant concept here, building a stack of undeniable proof that you are who you say you are.
A proof stack. I love that. It isn't about standing in front of a mirror reciting empty affirmations.
No, not at all.
It is a literal, undeniable stack of empirical evidence that you have faced down hard problems and solved them.
Yeah.
So for the 16-year-old, the blueprint isn't to try and predict what OpenAI is going to release in 5 years. The blueprint is to start the agency today, acquire one single client, solve one tangible problem, and place that victory into the proof stack.
Because when AI inevitably does change the macroeconomic game, that founder will have generalized confidence.
They will know how to pivot simply because they have a historical record of figuring out hard things.
The business requirement for a new founder isn't clairvoyance, it's resilience, built on a foundation of undeniable evidence.
Okay, so let's say you do that. You build the proof stack, you launch the agency, you conquer that initial emotional friction,
Right.
and you actually win.
Right.
The paradox is that the exact same aggressive acquisition skills that got you off the launch pad can actually become a massive structural trap once you hit scale.
Which brings us perfectly to the 25-year-old founder from our sources.
Exactly. Structurally, we are entering a completely different universe here.
We really are. We're leaving the psychology of starting and diving deep into the boardroom physics of scaling, and specifically why certain business models simply break under their own weight.
And the numbers attached to the second founder are just wild. I mean, this is someone who has successfully generated over $25 million selling B2C biz ops.
And just for clarity,
Okay.
that stands for business opportunities direct to consumers.
Right, which usually means selling courses, coaching programs, or systems that teach regular people how to make money, like a course on drop shipping or real estate wholesaling.
Right.
But despite pulling in $25 million, this founder tells Hormozy they have entirely lost their motivation. They are asking for a pivot strategy because they firmly believe this business vehicle cannot grow 3 to 10 times larger.
It's a huge wall they've hit.
I am genuinely trying to wrap my head around the math and the mindset here, because I think a lot of people hearing $25 million are screaming at their speakers right now.
Oh, I'm sure they are.
I mean, that is peak success. That is generational wealth for most people. If you are selling a digital course for, say, $5,000 and the market is buying it, why can't you just double your Facebook ad spend?
It seems logical, right?
Yeah. Why can't you just hire twice as many salespeople? Where does the physics of a $25 million business actually break down to the point where the founder calls it a low-leverage trap?
It does seem incredibly counterintuitive from the outside.
Yeah.
$25 million is a massive influx of cash flow. But when you analyze the deal mechanics and the unit economics Hormozy lays out, the reality of the trap becomes crystal clear.
Okay, lay it out for us.
Well, this founder has spent years acquiring some of the most valuable high-leverage business skills on the planet. They have mastered direct response marketing.
Which is huge.
Right, which means they know exactly how to spend $1 on advertising to get a trackable, immediate action from a customer. They know how to script and run highly converting sales webinars. They know how to recruit, train, and manage high-ticket sales teams that can close $10,000 deals over the phone.
I mean, those are heavy-hitting foundational skills. Those are the exact same mechanics that build billion-dollar enterprise companies.
They absolutely are. But the fatal structural flaw is that the founder has attached those highly weaponized skills to a fundamentally limited vehicle.
The B2C biz op.
Yes. Selling the dream of starting a business to everyday consumers, it's a deeply flawed vessel for massive, long-term compounding scale.
Let's look at the hard numbers. What is the actual ceiling on a business like this?
Hormozi points out a stark reality derived from analyzing thousands of businesses. It is exceptionally rare for a consumer biz op to scale over $100 million a year in revenue.
Wow, really?
Yeah, and it is even rarer for them to sustain that number for more than a couple of years.
So 100 million is basically the hard, unbreakable ceiling. But why?
Because of the underlying nature of the model. These businesses aren't built on compounding equity. They're built on arbitrage.
Arbitrage. Okay, let's break down how arbitrage works in this specific context. Because usually when we hear arbitrage, we think of high-frequency finance.
Right, like trading stocks.
Yeah. You buy a currency or a stock on one exchange for $1 and instantly sell it on another exchange for $1.10. You capture the spread with zero risk. How does that financial concept translate to selling a business coaching program?
In the biz-op world, the arbitrage essentially takes two forms, and both of them have a ticking clock. The first is media arbitrage.
Media arbitrage.
Yeah, so in the beginning, you might discover an untapped advertising channel or a specific type of YouTube ad that is incredibly cheap. Your customer acquisition cost, let's say it costs you $500 in ads to acquire a customer, is vastly lower than the lifetime value of that customer.
Who might pay you $5,000 for the coaching program, right?
Exactly. So you are arbitrating the cost of media attention.
But the advertising platforms are essentially auction houses. As soon as you start printing money, competitors see your ads, they figure out your funnel, and they start bidding on the exact same keywords and the exact same audience.
The secret gets out.
Yeah, so that $500 acquisition cost creeps up to $2,000, then $4,000, and suddenly the media arbitrage vanishes entirely. The spread just goes to zero.
The math just completely breaks. And then there's the second form of arbitrage, which is on the nature of the business opportunity itself.
What do you mean by that?
Often, these courses are selling a temporary loophole or a fleeting macroeconomic trend. Maybe it's a specific obscure way to run Amazon storefronts, or a brief window where a certain type of crypto trading is highly profitable. You package that loophole into a system and you sell it.
But markets are inherently efficient.
Exactly. Amazon changes its terms of service. The crypto loophole closes. The trend fades.
So the underlying product basically expires, which means the rapid leverage you experience, the very thing that allowed you to make $25 million at age 25, is completely unsustainable.
Yes. The sources quote Hormozi describing these businesses directly. He says they pop and disappear.
Pop and disappear.
Yeah. That is the life cycle of an arbitrage business. So going back to your initial question about why the founder is unmotivated, a high-level strategic entrepreneur recognizes when they are building an elaborate, beautiful sandcastle right before the tide comes in.
Oh, that's a great way to put it.
The $25 million is incredible cash, but it is not a compounding asset. You cannot take an expiring arbitrage vehicle and 10x it to $250 million because the foundation won't support the weight.
So how does this founder actually fix this? If you realize you are trapped in a low-leverage arbitrage game, but you have these world-class marketing and sales skills, what is the blueprint for a pivot?
How do you know which vehicle to choose?
Yeah, how do you find a vehicle that will actually absorb your potential and scale?
This brings us to Hormozi's Pivot Blueprint, which is fundamentally a masterclass in capital allocation. But instead of allocating money, you're allocating human capital and skill.
Okay, so what is the blueprint?
The repeatable scaling blueprint is this. You must forcefully detach your high-value acquisition skills from the low-leverage arbitrage game and reattach them to an actual long-term business vehicle.
Detach and reattach. So you take the direct response marketing team, you take this webinar mastery, you take the aggressive sales floor, and you just point that massive cannon at a completely different target.
Exactly. You point it at a business that has intrinsic enterprise value. Instead of selling a course on how to run a business, You build a software as a service company.
Because with software, you pay developers to write the code once, but the customer pays you a subscription every single month for years.
Right. That is compounding recurring revenue.
Mm.
Or you point those skills at a brick-and-mortar franchise rollout
Right.
or a B2B logistics firm.
You tie your aggressive customer acquisition engine to an underlying asset that compounds over 5, 10, 20 years rather than popping and disappearing in 24 months.
Exactly.
This brings up a really fascinating dilemma, though, because selling the biz up, selling the courses and the coaching is what people historically call selling shovels during a gold rush.
Right, the classic analogy.
Yeah, you aren't taking the risk of mining for gold, you're just selling the tools to the masses of people who want to strike it rich.
So is the selling shovels model inherently a bad business strategy? Or is it just the necessary high-margin and fast cash you need to bankroll a real gold mining expedition down the line?
That is the pivotal strategic question for any founder in this space. And Hormozi provides a framework that perfectly encapsulates the difference between generating fast cash flow and building massive generational equity value.
What does he say?
He uses two parallel metaphors in the sources that just hit the nail on the head. First, he says, the fastest money you can make is selling ladders, but the biggest money you can make is climbing them. Selling ladders versus climbing them. You can sell a ladder to 100 people today for cash, but if you climb the ladder yourself, you reach the higher tier of wealth.
Exactly. And the second parallel directly addresses your point about the gold rush. He says, the fastest money you make is selling shovels. The biggest money you make is actually finding the gold mine.
So translating that back to our scaling blueprint, the Biz Up, the digital course on how to start an agency, the coaching program on day trading, that is selling the shovel.
Right.
It is undeniably the fastest way to generate cash flow because the profit margins are astronomical. The fulfillment is usually digital, meaning it costs you almost nothing to deliver the product to 1,000 people.
It is rapid, highly profitable transactional leverage.
But transactional leverage has no memory. It does not compound. You start at zero every single month. True scaling requires migrating to compounding leverage. It requires owning the underlying asset.
Yes. When you climb the ladder, or when you buy the gold mine itself, you are building equity. If you build a massive software company or a logistics empire, you might not see a $25 million cash influx in year 1.
You might be reinvesting every single penny.
Exactly.
Okay.
But in year 10, you have an asset worth hundreds of millions of dollars. You have an asset that Wall Street values, an asset you can sell to private equity or take public. Wall Street pays massive multiples for compounding predictable revenue. They do not pay multiples for a one-off course sale.
It is the fundamental difference between income and wealth. The 25-year-old founder has completely maximized income. They have mastered transactional leverage.
But they have intuitively hit a wall.
Because they realize they have zero compounding leverage. They're standing on top of a mountain of sold shovels and realizing, wait, I don't actually own a gold mine. I have cash, but I don't have a legacy asset.
That realization, that's the threshold that separates a tactical entrepreneur from a strategic founder. The tactical entrepreneur is always chasing the fastest money, jumping from one arbitrage loophole to the next.
While the strategic founder has the patience and the discipline to deploy their high-value skills toward the biggest money, building something that outlasts the current market cycle.
Perfectly said.
Bringing this entire narrative full circle for you listening. Building a massive, enduring business really comes down to a two-step, repeatable blueprint that we've pulled from Hormozi's advice today.
Step 1 is entirely internal and psychological. It is generating that stack of undeniable proof to conquer the paralysis of the unknown.
Whether that unknown is the threat of artificial intelligence, a shifting macroeconomic climate, or simply your own imposter syndrome.
You cannot outthink the fear. You outwork the self-doubt by giving yourself empirical evidence that you can figure things out when it gets hard. You start 100%.
And step 2 is entirely structural and mathematical. Once you have built that proof stack, once you have survived the early days and built incredibly high-ticket skills like direct response marketing and sales, you have to audit your business vehicle.
You have to be radically honest with yourself about whether your hard-earned skills are attached to a vehicle capable of true compounding scale, a gold mine, or if you are just getting seduced by the fast transactional cash of a short-lived arbitrage opportunity.
It is the conscious migration from the domain of quick cash flow into the domain of massive compounding equity value. It really forces you to audit exactly where you are deploying your energy every single day. Are you building a sandcastle or are you pouring a concrete foundation?
Such an important question to ask yourself.
Definitely. So, we're going to leave you with a final thought to mull over today, something that builds on everything we've just unpacked but flips the perspective entirely.
Let's hear it.
Think about this. The 16-year-old is completely paralyzed, running away from artificial intelligence because they view it as a threat that will destroy their small agency idea.
Right.
Meanwhile, the 25-year-old has millions in cash, but desperately needs a massive long-term vehicle to build real compounding equity.
Okay, I see where you're going with this.
What if the very AI that the 16-year-old is terrified of is actually the underlying gold mine that the 25-year-old needs to build their next multi-hundred-million-dollar enterprise? Are you currently running away from the exact thing you should be trying to scale?
Oh, wow. That is a brilliant reframing. The obstacle might actually be the vehicle.
Think about it.
Yeah.
We will catch you on the next deep dive.